Once upon a time in the same city but leading very different lives, there were two friends, Jane and Trisha. They both grew up with a solid understanding of the importance of saving, but how they chose to save their money shaped their future in ways they couldn't have imagined when they first started. Jane's journey, steady but safe. Jane, practical and risk-averse, started saving £100 a month when she turned 25. She had heard the value of building good financial habits early, and so she diligently put away her money into a savings account. At the time, the interest rate on savings was around 1%, which seemed reasonable. Jane wasn't one for risk. She liked knowing exactly how much money she had and feeling secure about it. For the next 40 years, Jane stuck to her plan. She never missed a month of savings, accumulating a comfortable sum of £100 a month. Her account grew steadily, and the small amount of interest was a nice bonus, though not significant. By the time she was 65 and ready to retire, Jane had saved £48,000 of her own contributions alone. With the 1% interest compounded annually, her total had grown to roughly £61,850. It was a respectable sum and gave her peace of mind, but Jane realized it might not be enough to live the retirement of her dreams. Trisha's adventure embracing growth and risk. Trisha, on the other hand, was curious about investing. At the same age as Jane, she also began saving £100 a month at 25. But instead of putting her money into a savings account, she decided to invest in the S&P 500 index fund, having heard that historically it had returned about 7% per year on average, after accounting for inflation. She knew there were risks involved, as the stock market could go up or down, but she believed in the long-term growth potential of the market. Like Jane, Trisha was disciplined in her savings. She too never missed a month, always contributing £100 to her investment fund. There were years when her investments fell sharply, like in 2008, and she felt nervous, but she stuck to her plan. Over time, her investments grew exponentially. By the time Trisha reached 65, her total contribution was the same as Jane's, £48,000. However, thanks to the power of compound growth and the higher average returns of the stock market, her portfolio had ballooned to an impressive £268,000, assuming an average return of 7% annually over the 40-year period. The retirement years. At 65, Jane and Trisha met for coffee to talk about their upcoming retirements. Both were proud of their diligence and consistency over the years. Jane felt comforted by her safe approach, while Trisha couldn't believe how much her investment had grown, especially considering they had saved the same amount of money each month. Jane, with her savings of £61,850, realized she had enough for a modest retirement. She could live comfortably, but had to be careful with her spending, especially considering inflation would eat away at the purchasing power of her savings over time. Jane planned to supplement her savings with her pension, but knew her lifestyle would need to be quite frugal. Trisha, with her investment of £268,000, had far more flexibility. She could afford to take a few holidays each year, help her grandchildren with school fees, and still feel secure about her financial future. She too had a pension, but her investments gave her a significant boost in both freedom and lifestyle choices during retirement. The two women sat together, reflecting on how the same savings habit had led them down such different financial paths. Jane's cautious approach had given her peace of mind but limited growth. Trisha's decision to embrace the stock market, despite its volatility, had paid off in the long run, significantly enhancing her wealth. The tale of Jane and Trisha is a reminder of the power of compounding returns and the different approaches one can take to saving for the future. While safety and security are important, investing wisely in long-term growth assets like the S&P 500 can dramatically change the outcome for those willing to endure some risk. By retirement, the difference between saving and investing can mean the difference between a modest life and one filled with opportunities. Thanks for watching, and please subscribe to the channel.